All right, so this is going to be just a quick market scan. Um, just how we've traded this week, what's happened so far, where I fucked up at, um, the idea and the plan that I have going forward, and why this is happening. Right? So, we obviously didn't get the gap down that I expected. Well, that happened anyways. We obviously had the gap down over the weekend on weekend Wall Street, and a gap down on futures Sunday night as well. And we managed to open green, right? We managed to open relatively weak green, but green nonetheless. And um, this is happening post June options expiration, right? The 20th. But we still have the quarterly expiration on the 30th. We still have maybe not as extensive of the Vanna charm flows, but more or less the painting and the positioning that moves these markets. You pay attention to February. I'm kind of comparing it to this range. This leads into the February expiration, right? And it leads, and what comes before that expiration is this exhaustion at new highs. Um, and your clear, dip that's bought on the February CPI report on the 12th, your continuation where the volume is diminishing, the spreads are, smaller, and the effort from a buyer's perspective of things is just not there. It's just the passiveness and the time frame before that seller can show his hand, right? I've previously talked about that Summer of George um, scenario, especially coming off of what we had in April. There's no surprise that we see this rally. New highs is a little extensive. I didn't necessarily think that this would happen the way that it did, but that's fine. I mean, I just get to learn new things. I get another experience, or more experience to put under my belt for the next time an opportunity like this comes into play. Right? I said it was not a generational dip buy, and I do stand on that. I don't think that was generational. I think that was April, early April to mid-April. Phenomenal long opportunities on a large amount of equity that has room to run in the gaps above. But now, as I've been saying the majority of May, as I've been saying, even though we continue to see this exhaustion and trade higher, it's not structural, right? There's gaps left below. There's no clean structure. This is a really nice dip buy on Monday, right? And the relevance and reasoning behind that is, we have the 603 gap unfilled from that Tuesday session on the 17th. And we have the preliminary signs. I thought this would pop on Friday's session, 0 DTE OPEX buyback, because of the, I guess you could say, historic sequence that happened with the high implied vol event in the Fed meeting and the day off prior to the expiration. I thought we would have some buybacks that would occur. That didn't happen. And we got the week close. Right? We got, not a big pop in the close like I expected to happen. That has the potential to happen on an OPEX. Right? I knew the risk to reward taking a trade like that. It's a very speculative idea, but it's an idea nonetheless that I've seen come into play, come to fruition many times with how these dealers are positioned and how they give you the footprints of the way that unwinding and de-hedging can potentially unravel. um, like I said, there's things under the hood that are very, very influential in the way that these financial markets move, and it's not even necessarily manipulation, it's just position hedging. The options rule the market, right? The indexes are more powerful than the single stocks. The money and liquidity within these, and specifically the options, has, very important effects on the way that the underlying moves, how freely it can move, how vol can move, and the time frame and the cyclical sense of those things also plays a role, right? We have, quarter four and early quarter one is usually not. I mean, usually is speculative. Usually is that time, especially late quarter four. Closer to December, closer to holidays, early quarter one. Right after New Year's, before the January expiration, which is the large single stock expiration. You have those flows and seasonality effects that can give you a good environment, right? Obviously, we had the preliminary signs of a higher time frame distribution playing out last quarter four, right? But still, nonetheless, it wasn't a terrible environment. We had long opportunities on a lot of names. We had the accumulation into the election gap, and if it's not, it's just relatively stagnant. And then you come into quarter two, right? Or late quarter one, early quarter two, right? We obviously see some volatility pick up post February expiration into April. And then those April flows kick in. We see the reversion trade and the subsequent digestion, right? And this is very similar to 2024, right? You had the rally off of October lows. We had the kind of preliminary signs of distribution happening in a lot of tech equity, happening in a lot of semiconductors that were leading the market, AMD, most specifically, as far as like real distributions playing out on a higher time frame perspective. And you had the rotation in energy, right? You had those risk off names, seeing that rotation into them for that short period of time, the quick markdown into April, into that summer of George kind of scenario, right? Now, what that summer of George is, right? So you think about liquidity, you think about active market participants, right? It's what drives these financial markets. It's what, that supply and demand is what determines the price, right? Without buyers and sellers, it would be nothing. Without people looking to buy, people looking to sell, it'd be nothing, right? And then you think about the window of the summer, right? May, June, July. Vacations, holidays, right? Just low liquidity environments where these flows can pick up and prop the market up to a sense, right? You pay attention here. We bought it in April, right? We had the kind of, you know, smaller time frame distribution that was playing at hand here. The nice breakdowns off of, I'm pretty sure it was Israel again, some kind of war news. And then it was just kind of a smaller shakeout. A lot of names still had room to run. In my opinion, this kind of late quarter one, early quarter two sequence on a lot of equities, specifically financials and semiconductors, was the preliminary signs of a lot of money rotating out of those names. But that's, for another discussion. But nonetheless, we see the rally, right? And we see it from late April into mid July, right? And we're seeing a very similar thing here, right? We're seeing the bottom form out, the bottom being an event, right? August 5th, an event, the carry trade, April 7th, the tariffs being an event happening on a Monday with a nice footprint. This was a little bit more historic of a sequence that happened. The subsequent consolidation of such an aggressive 10% candle on the ninth, and then the continuation higher. And a lot of red flags after May OPEX, though. I think the preliminary signs that May 12th gap up was the start of the climax, right? We see the Moody's downgrade post May OPEX. We see the expiration in the bond auction give us that total of 3% move to Friday, to that previous floor of accumulation from quarter four to quarter one, or from quarter one, 2024, or 5. Sorry, that was failed and pinned under in March, on March 7th and 25th, most specifically. And we see the continuation higher, right? And it's a lot of red flags across the way, in my opinion, right? A Memorial Day gap on low vol. We have the gaps left above. We have the court ruling on the 28th. That's failed. We have the continuation higher. The failed breakdown on the 5th. They got me there. The slow, exhaustion in the CPI, which was a top. The breakdown into that June 6th gap on the 13th with the Thursday vol spike and energy catching a really nice bid. And then the new week opening gap up that's faded. And last week, right, the week of the 16th was just, a good week to kind of take off, in my opinion, at least on some names, right? We had the kind of bid that bailed through the 597 INWOG. And then, like I said, I was pretty confident in a spark end of day. We had the preliminary signs of a buyer within this 593 gap, which was the full fill from the 6th. And we get that on Monday, right? We see the insanely high vol, the subsequent digestion, and the continuation on this on this pop, and the draw simply just being back into that 603 gap. Obviously, we established new highs, but the risk reward on this trade long is, the first actual opportunity you have that's super appealing to me. I mean, this is not really appealing. This is a phantom print. This is an end of the month kind of re-leveraging or de-leveraging. This is your first real appealing long, and we rally off the lows, 3.5%, about to trade the new all-time highs. It's a good long on an intraday move up to 600, in my opinion. And I didn't necessarily take that into consideration, right? We had the massive footprint, the third low of this campaign, the climax being built out, and all happening within that gap, and then a subsequent high low, and just an aggressively easy move and consolidation to a really strong closure on a daily print. And it's just one of those things. We see the continuation, but I will say, the way that this is carrying out, right, while that was a good opportunity long side, which I didn't end up taking, we see continued exhaustion, and I think it's leading into June 30th expiration, and I think it's going to lead you to a true UTAD on the broader market as a whole. That's just the way I see this panning out. I think this is going to end up being our third high, with your first high being on the 19th, your second high being on CPI, your third high being on either some exhaustion or a footprint. Oh my goodness, I'm just fucking everything up. Or a footprint above the new highs, right? And I think we see a window next week where you can short this to 600, and then maybe play the lower high post-July OPEX down to 579 potentially, right? It depends on how it develops. I do think above these highs, though, a execution is definitely warranted prior to the July flows kicking in, right? Obviously, if we somehow break and base this previous all-time high, that'd be very interesting. It's just focusing on the tape above this range and the way a lot of the names look. But the exhaustion is very evident, right? It's very similar to February. It's just, it's not anything that I'm surprised by. It's just something that's been very difficult. You know, I'm not gonna lie, I fucking gave it all back. My port was up phenomenal this year. I didn't make as much as I wanted to in April, right? Hindsight's 2020, but I didn't play this how aggressively long I needed to be. With the risk to reward at hand, not even the 7th into the 9th, and then into the 576 or 476 gap on Qs. I just didn't even long this. I chose a bad vehicle. I didn't get the execution that I wanted, and I was left out of that rally up to 476, and then the April 30th kind of GDP bid, reclaiming 466 and 545 into those reports on the 1st. And then we obviously have that kind of in wog of 3%. I built out the shorts. I shorted it, gave back the gains, and then just mis-executed the entire range. They got me. And I think that it's one of those things, right? The mental capital is very important within this range. There's not a clear edge. Yes, there's some intraday opportunities, but throughout this entire experience, I've found that the opportunities that I'm more suited, more appealed by, are just the higher time frame perspective of things, right? Slamming those longs in early and mid-April, building out these shorts in mid to late July, June to early July, right? On specific names, on time, or on leverage ETF exposure. Because the context is bearish, but it's not ready yet. And you can kind of see that it's not ready yet. I got caught on the failed breakdown. I got shook out on the June 12th print. And then I tried to kind of short the hole on Monday this week, right? And it just didn't pan out on NVIDIA specifically. But my context, my idea of how this plays out here is going to be a UTAD within this range and a pullback to probably, I would say, from the highs, probably a 10 to 15% decline from new highs. I think we'll pull back and just develop a subsequent LPSY post July expiration, maybe in August. And then quarter 3 and early quarter 4, we'll probably pull back to 550, maybe 530s, and then maybe develop a lower high into mid quarter 1 of 2026. That'll push us to new lows, right? So my focus here would be that short position on time, on quarter one to quarter two expiration expiring next year, um, taking time, waiting to really get heavy size until you see a massive footprint in that window of quarter three open up, and focusing on 564, focusing on 554, 545, right? Pivotal points within the chart. But the way that these gaps are left unfilled and a lot of individual names look, I do think we pull back into these gaps. You see a decline. You can even just pull your fibs probably to maybe 530, 5 to 527, which was that April 23rd gap, that path of least resistance. And then I think we're going to see that lower high on a macro perspective developed late quarter four, early quarter one of this year to next. The context is still bearish. My perspective and my ideology has never changed. It's just the way that the execution pans out. I've found that there's a much better, a better opportunity, right? I found that there's just a much better opportunity. The player that wins within this range, is the player that has a long-term bias, right? Coming in here day by day, within this environment ever since April, I've really gotten eaten up, and it's more of a mental capital issue as well, right? Just coming in and having this idea getting faken out, having the context still hold in the CPI and getting shaken out as well, and then just finally taking the massive L that kind of put me underwater. And it sucks, but it really doesn't. I feel like it was inevitable with the way that my performance was. But I do think that my broader context is still there, and short positions on a handful of names are not bad at all. You look at QQQ, we're pushing new highs, but the subsequent exhaustion that's kind of developing within these, Tuesday, Wednesday, Thursday prints, I do have a feeling that, tomorrow could technically be a parabolic short. I do have a feeling in a sense that post June OPEX is going to be our top. Right? I think we're in the midst of topping out currently. I think all these gaps being left unfilled, the lack of a real clear structure within a lot of these names and a lot of these charts, and the indexes as well. I think that's a major red flag that a lot of people fail to understand, and I think even QQQ visits back to probably sub 480 in quarter three, potentially, right? I think something happens. And I think on a broader perspective of things, something happens as well. I think this is a higher time frame rotation out of equities, which is such a speculative idea. I think ever since COVID, we've had such a everybody's just been everything's been free. Equities have just been trading higher. Um, and I just don't feel like that 5 years. I compare this a lot to maybe even 2000, right? Just an aggressive run up the preliminary signs of distribution, and I don't know. It's hard to explain, but there's something about this market on a higher time frame, meaning a couple of years, that leads me to believe that it won't perform as good as it has the past five. And a lot of people aren't going to understand why. Things don't just go up and up and up and up. Right? I'm not saying it's a bubble, but it could be a bubble. If it looks like a bubble, it sounds like a bubble, it acts like a bubble, it might be a bubble. It might be the housing market as well. There's something that's going to happen, I think, that maybe a recession, maybe something. I don't even want to speculate on the idea of what it could be, but I think there's something that is currently happening, a rotation out of equities that's going to be catch a lot of people off guard. I think that it's a higher time frame perspective of things. I don't think that there's I don't know. It could be a lot like this scenario where we have the 2000 top, the 2002 bottom attempt, and then the 2007 stall for 7 years. We went nowhere on equities, following, 4 years of aggressive returns from 1996. I would not be surprised if it's something similar to that. There's a lot of just red flags on a higher time frame perspective as well, with the way that equities look. And I think a lot of people are going to get caught off guard. At minimum, I think it's something similar to 2022. At maximum, I think it's something similar to 2000. I will say I don't mind how the financials look. We didn't get to pull back into the sub $49 gaps, which isn't really too concerning for me. This is still a bearish chart. A lot of the individual equity within this sector still looks very gross. I always said that, the gap fill at 51.62 and the 2024 highs being taken out was a possibility. I wouldn't even mind an all-time high push. I think that would significantly, I think that even with NVIDIA, which I'll talk about, it would significantly, it would make these charts significantly more appealing short side, like we have in NVIDIA, which I'll talk about in a little bit. But JPM all-time high push. I personally think that this is a distribution that's been panning out since quarter 2 of 2024. Coleman's or Schwab. This is a daily distribution within a weekly distribution within a monthly distribution following a massive decline in 2023. I think this seems sub $50 2027. Goldman Sachs all-time high push, but I don't have too much of an edge on this chart. I do think that this is a distribution, and a lot of it's the election. A lot of hands changed on the election. And I think a lot of hands are changing right now. I think a lot of people are getting better. Like look at MasterCard, look at Visa, look at these progressive stalls at all-time highs. It's not unwarranted. A lot of rotation has been happening in my opinion. NVIDIA. I mean, this is obviously I was really aggressive short in this range. We see that larger seller last Monday the 16th at that kind of high that I wanted taken out at 146 with that bunch of volume, 2 million volume back behind that candle. The subsequent inside bar, the bid on the NWAG on Wednesday where I cut my position. And then we had, 20th, another fake out print, right? And then we had the gap down. They bid, reclaim the February, or the January 24th closure, right? Kind of reclaim the February highs, reclaim the earnings print as well. Just a pivotal range within this chart to be reclaimed and established on a daily closure. But I do think that this is developing a true UTAD, right? You have the aggressive influx of volume as we break out, and then the subsequent significant exhaustion with the way that this tape has been acting. I think this is just a larger seller off the report and in May 21st range where you get the run up into the report, another offloading of inventory. And then we have this kind of UTAD of this range on one hand, but within this range as well on a weekly perspective. I think that this is a higher time frame distribution, following 1,000% run up from 2022 lows into 2025 highs. And I think that this is a name that's seeing a lot of money rotate out of it on a higher time frame perspective. A lot of it from insiders. But yeah, I think this is going to develop a UTAD. You compare it a lot to AMD in Q1 of 2024. You see that kind of breakout candle, the continuation, and then you start to see that volume either die down, signaling a lack of buyers in a passive seller, or that volume kind of ramp up and those spreads get smaller, signaling an aggressive influx of an effort from buyers and a lack of result, signaling the aggressive seller at those highs. And then you see the massive footprint on the 8th, which is where you saw larger seller in NVIDIA as well, the highest volume we've had in a while. That's the highest volume we've had since 2019. We still haven't even cracked that volume that occurred on March 8th, right, which is a major, major red flag. We leave these gaps unfilled below. We see the exhaustion above highs. I think this pulls back to 110, $115 this year. As of right now, that's a 25 to 30% decline. I don't mind the NBDS positioning around 143 up to here. I mean, that's a 15% decline on the underlying on NBDS for a 45% return. Obviously, taking some ads within this range, but I don't know. It was never super clear, right? Like this happening is not super surprising to me because it was never super clear. I just mis-executed and I got eaten up because I was the little fish here thinking of the smaller perspective of things, right? I was not thinking of I was, but I wasn't executing on a higher time frame perspective. It just wasn't. It's not how I have a portfolio to do. I was trying to catch, a day by day move, week by week move. The money is made on a higher time frame perspective. Adding in the winners, cutting your losers, understanding when a position's a loser, understanding the time frame of a position. A Q3 short on equities is a fucking phenomenal idea, in my opinion. And you can get exposure on Leaps, on SPY. You can get exposure on NDDS, SPXS, SQQQ, and you have clear targets. Look at the gaps left behind. I think we visit 75 next year, personally, to 67. But NVIDIA. I mean, this is a true UTED, and this makes this chart so appealing. I mean, obviously, this might not be the top, but the progression is weak. The spreads are dying out. The volume is so high on that breakout candle, just the influx of buying, and it's just like absorption of demand potentially happening. The hands just changing. For someone to sell a position, someone has to buy it. And that's how these hands change. I do still like Tesla. I actually long Tesla on Monday. I talked about this a lot. This was actually my weeks. I long Tesla on Monday, and I shorted NVIDIA lower high range. Right. I went actually really green, and then I gave it all back, going super red on NVIDIA, and then taking a speculative XLE position, which I'll discuss. But Tesla is just a simple path of least resistance, right? I mean, this is a chart that I still like long, right? I mean, the name of the game is long, right? Stocks are supposed to go up. That's the point. But you have to understand when the risk reward long side is no longer there, and maybe when the risk reward is skewed to the short side. I still like Tesla long. I long this off the path of least resistance. A week of consolidation after this massive footprint within this bear gap and the subsequent higher low that was established. All we saw was an INWOG and then like a 5-minute kind of base off 332, which was my risk. We see the rally. I cut most of my positions for 45% on weeklies. On like this print, like an idiot. These ran from 1.3. I cut them to like 1.7 average, if I'm doing my math right. These ran to like $6 on some weekly positions. So, I mean, yeah, if I would have just long Tesla this week, I would have been phenomenally set. And I wouldn't have blown my portfolio. But obviously, if I'd bought $600 calls expiring June 30th on April 7th, I would probably be a millionaire. I actually kind of want to see that. $600 calls expiring here. What were these priced at in April? Sheesh. $53 to $1,200. That's an insane return. I actually kind of wanted to. Yeah, it's an insane return. But I still like Tesla. Obviously, the play here is shares within this range, and then within this on like shares and TSLL. Smart plays to take some off and then target 360 to 380 to 400. So you have your stop set. But I really do like this chart still with this capitulation print, where it comes off of the following subsequent price action and tape that's following that, and just how it behaves, right? And still though, I think this trade's probably 213. We still haven't filled the October peg. Meta, this is a fucking hideous chart in my opinion, right? This is a chart that I mean, I was very short side focused on here on the report in May. I still think it's a very gross chart with room lower, and leaving these gaps unfilled is just it's solidifying a draw, right? These are going to revert to the mean. The mean reversion always happens, whether you like it or not. Take Microsoft for example, right? Take Microsoft. We had the report give us a 6% gap down January 30th, and then we had the kind of continuation lower at some point. There's just not enough supply down here. There's not enough sellers within this range. And the reversion and the draw is going to be to an area where there's a larger amount of supply whenever the time is right, whenever the liquidity is generated one way or another. And we see the sell climaxes being built out. We see this selling getting absorbed in early to mid-March. And then we see the massive kind of changing of hands and on the 4th and the 7th and the footprint and the consolidation into the report. And we just easily revert into that gap, a 7% day on the report in May 1st, right? And now we get the continuation higher. We get no clear structure. We kind of see the potential sell or buy climaxes being built out. This is going to revert to this 395 to 425 gap, right? And it's going to happen quickly. It's just how these things happen. They happen one way or another, whether you like it or not. The reversion of the mean is always going to occur on multiple different time frames. Ever, always, like it's never not gonna happen like that. But I think Meta is another like rotation out of a name that rallied from $80 to $750 from 2022 to 2025. We've seen the preliminary signs of distribution following the February 2022 report. We've seen the lack of any lower lows developed, and it's instead the opposite. We see the potential for this to be our UTAD. They kind of absorbed this seller at the 703 gap. We see the full gap fill here, and we actually see a dark pool right under the highs on TradingView, which is weird. You never usually see that. I wouldn't mind a true UTAD. I mean, that's 4 months for a new all-time high, leaving these gaps below. If that's our true UTAD, that's a fucking beautiful one. I don't mind that. The Google chart is something I don't mind long, similar to the reversion of the mean on Microsoft. I think this has a little bit of room left. We obviously see the May 2020 or March 2024 gap filled that was previously based in September. A lot of hands changed with that low being taken out, and then the subsequent pop and higher low. We obviously see a seller off the report, and then this massive footprint in early May, like this capitulation print. Pay attention to how these act and where the volume comes in at. Oftentimes, it can just potentially be a fake out, similar to Tesla and how this was. We break, we base the top of this print, kind of absorb all the supply within that range. Now we do start to see a notable seller off this news in mid-May, a higher low, and then another subsequent kind of influx of volume at the highs and a nice leg lower. So a good amount of red flags developing. 25% of the lows. And then I do think that this trade's higher. This is a nice kind of print on Monday. I would like to see some continuation towards 182 to 192.75, maybe 200. This is a name that, I mean, great opportunity long in April, great opportunity long in May again. On this print, maybe not great, but a name on this higher low specifically off of a pretty pivotal point that I think can take you a little bit higher, right? If there's anything I'm wrong, it's this and Tesla, and that's pretty much it. And then Apple as well. Being a name that I would like to see higher, as far as just, like I said, the draw to this full gap fill and 618 range at 224, which I've talked about a lot. I mean, it's just things like this kind of like pop and exhaustion and ugly sequence into this Tuesday print. They just keep catching me off guard, and they finally got me. But my contextual directional read on equities on a quarter by quarter, year by year basis is still bearish. And I've kind of realized throughout this sequence and this sequence, obviously this is an insane amount of volatility. I've just realized that that's where you eat. The day by day thing is a very difficult opportunity, and not where the bulk of your money should be focused on being made. It should be on large positions with a time horizon set for said position in the correct vehicle. Like I said, SPY 2026 puts down to 564 to 554 to 545 within quarter three to early quarter four is a position that I'm not afraid of, that I really like. But you know, trying to go day by day, it's just been difficult, and I've realized, the last phenomenal trade I had besides this that I ended up giving my profit back was April, and that's not even the best way to capitalize off. You have three opportunities: the 7th, the 8th, and then the 9th, and then the 21st, maybe the 30th, to really get long shorter exposure. But the mental capital is there. Is not. Is it worth it? Is it worth it to just buy shares and leverage ETFs, set your alerts, and fuck off? Understanding the context and the time frame you're coming into, because I think that that's the case, and I think that it's opened up so many clear ideas for me on how to better read these markets. I mean, Snow, a phenomenal opportunity down here on a name that might not be the most mature of accumulations off of these lows, but a massive footprint in November, a stall within this March peg or February peg, and then a higher low filling the gap on the highest volume we've ever seen on a 20% report. 30% pop on the report. Following the stall in this gap, we fill it, we see the subsequent structure develop, and just the easy rally higher. And I think this fills the full 230 spot. That's a $100 move on the underlying. That's 70%. I mean, that's a phenomenal trade. and it's just shares and fuck off. Set your stops, set your alerts. Obviously, trim the majority, but understanding context like that. And I mean, this didn't offer the cleanest opportunity. I can't really be too concerned about missing this, but I always said that this could be the spring that we needed. It's a little difficult to try to time a 26.82% move as the spring, but the subsequent 7% candle that we get after on higher volume is a little notable. We had some consolidation. We never saw a really clean structure besides post May 12th gap, but just rallies you, right? All that liquidation, Druckenmiller liquidated his position, all that selling absorbed by a party, undercutting these lows, sparking a rally on a range that's absorbed at it's like the supply is wiped, the draws into these gaps above. I mean, you have a name like Hood making new highs. I'm not fond of this name right now. I think this revisits 25, maybe even lower. Um, but you never really got the opportunity. Same with Palantir. I don't like this chart. I don't think that the campaign established at the lows is enough to outweigh the campaign that's been established the past 7 months since November, personally. TSM, I mean, I don't know. That June 20th print, these semiconductors kind of took a hit, and then we recovered on Monday, and I see the continuation Tuesday. Breaks through the 221 deep sea gap fill. This might develop a full true UTAD. I still think this trades at 133, probably lower. But right now the focus would just be probably like 175 by end of year. I don't know. It's a difficult one. I cannot lie. It's a difficult one. This is a difficult market for an intraday options execution. And the idea here is less is completely more. And they got me. There's things under the hood that are really important within these markets that play a big role. And it's a lot of reasoning as to why this time frame is panned out like it within this time frame. And it's something that has opened my eyes and given me a lot of experience on how these markets move and where the best opportunities, not only money wise, not only where the opportunities to make money are, because that's the goal here. Obviously, I mean, I do love the equity market and the stock and the financial markets in general. The goal is kind of to make money. Maybe not all the time. Sometimes the goal is to preserve money. But I feel like the goal should be to make money in the least stressful way as possible. And what's the least amount of stress? Like, what's the positioning throughout the entirety of this year that offers the least amount of stress? It's not weekly or bi-weekly options every single day. It's a broader directional read within a certain window and executing appropriately. Maybe taking those stabs internally every now and then, but not trying to build the bulk of your positions out day by day. Instead, focusing on the broader context of things, understanding the windows that we have, not only on a week-by-week perspective, but on a monthly, a quarterly, even a yearly perspective. And understanding the correct vehicles that don't always have to be options. Maybe leveraged ETFs, maybe inverse ETFs, something like that. Maybe just long comments. That's the best opportunity on a lot of these names, is long comments. You even look at the energy sector. It's not the most appealing look, I will say, with a lot of volume off of a pivotal range, 2023 lows and 2024 hitting the top of this 2022 gap. And then the subsequent 1, 2, 3, 4 inside bars, failed breakout, then higher low. There's a lot of consolidation here. Now, is there really an opportunity within this range that I'm bidding options? Absolutely not. There's absolutely none. But the opportunities within here on shares, I don't mind it. I don't mind potentially taking a stab on some shares on this May 30th anomaly print on ZOM. Right? The subsequent consolidation that develops is relatively appealing. Not CDX. Probably not Oxy. VLO is a really nice one. Basing the April 3rd print. Beautiful shares opportunity in early June. Right? There's an opportunity long on energy in June. This was the first preliminary sign on June 3rd, and then this massive capitulation kind of threw me off. And then you see the rally. You see it happen on the 11th that in comparison to how SPY and how QQQ looked, that really appealing print. Same with the 12th, that kind of faked me out with the vol pop, whatever. I can't be super overly bullish energy though. They just have potential to trade lower, a lot of these names, and I don't know. Shares work wonders on a couple of these in late May to early June. Don't mind that at all. that's where the money's to be made in a lot of these environments. And I think you always have to take into consideration mental capital of a position. Obviously, it's really relative to where you are, what your portfolio is like, what your risk is like. But I think that's really pivotal. And I think that was where I got eaten alive at. Not even physical capital, more mental capital wise. Um, Personally, ARKK just absolutely running. Um, I don't know. I don't know. It's hard. It's a difficult read. I think coin crashes. This is getting a little extensive, a little parabolic, I will say. What's like MSTR doing? Absolutely nothing. Um, I don't know. I, I don't mind the short exposure on a high time frame perspective of things. I think that's the goal here. And I think that's the move. I think that's the way. I think that the opportunities and the red flags have been shown. And I also have I have a perspective for the next quarter. I have a perspective for the next two, 2 to 3 quarters, maybe even four, probably the next year. And then I also have a perspective of what I think the equity markets will be like probably into 2030. Um, Obviously, there's no point in looking forward that long, but I will say, looking at the broader market since COVID, I do think that there's the potential for a lot of this to be euphoric and a lot of this to be genuinely catching a lot of people off guard. But who knows? I don't know. I do. I would. I think there's going to be a vol event soon. Um, I was potentially looking at one on the June 18th Fed meeting of expiration, similar to the December 18th one. Obviously, we didn't get it. I didn't even have any positioning into that. But um, but nonetheless, I I do think a ball event comes soon. I think that it's the timing aspect of things. Talked about the summer of George. And you look at kind of how it happened in April as well. I mean, not surprised that we didn't get one, and I wouldn't be surprised if we don't get one until April. But I do think that summer of George it happened. Um, it's not always going to happen when you have low volatility low vol. Um, there's also a pinning of indexes as well that creates a lot of dispersion and non-correlation between a lot of names. If indexes are pinned, they're not really going anywhere, which is kind of what's happening. I mean, this is not really going anywhere, honestly. Like, really. Monday, we were at the same place we were a month ago on May 16th at the closure. Um, from May 16th to June 20th, we didn't move. Then we get this 3% rally into a window that's kind of, quarterly expiration. That's a little it's a little red flaggish. Exhaustion on a lot of names and individual names giving use to the UTAD on NVIDIA and SPY. We didn't move in a month. And now we get this. And look at when it's happening, and look at how it's happening, and look at the structure and the price action and the correlation between a lot of names that give you those red flags beforehand. That's big. That's really big. I mean, this is not going anywhere. And because of that, you're going to have non-correlation between different names, different sectors. If this is stagnant, there's things going up and there's things going down, right? If everything's going up, everything's going up. If everything's going down, everything's going down. If we're pinned, there's going to be things that move away from each other. Um, and that's kind of what's going on here. But that's essentially, market talk discussing 2020 quarter three plans. Quarter three short still stands. Windows, window trading. Just kind of typing out the title here. Window trading. Summer George, which is a Jem Carson thing, but it's a concept that is important. First decent buy, decent long. What else? What else did I talk about? Mental capital. Preserving mental capital. And where's my edge? Yeah, I mean, I think that's all it comes down to. Where is my edge at? And I've found that the best edge that I've had that is the least amount of stress and the best amount of potential and vulnerability is higher time frame perspectives. And it's just slamming the ideas that you're really confident in. Quarter month by month and quarter by quarter is kind of where I think that sweet spot is, right? Like I said, you know, for the month of April and the majority of the early quarter two portion is that long focus. Building out longs, getting a cushion, covering those, rolling your profits, cutting those positions in the mid quarter two, right? Late quarter two is kind of covering those longs, building out those shorts, right? Into a quarter three short, I think that pans out into quarter four, right? So I would appropriately want to position for that. Would appropriately want to cover that. Maybe would appropriately want to take some long exposure before I take more short exposure in quarter one next year. I think that quarter by quarter window, right? Obviously, you can go day by day, right? Okay, where are we opening up at? What's the structure look like today? I don't like that because, you know, yes, it can be vulnerable, but you're obviously going to have some days that don't have a lot of volatility. You're going to spend a lot of time and energy on things that are not necessarily vulnerable week by week. Okay, that's when it gets a little bit better. I still think the sweet spot is kind of monthly to quarterly, where you're focusing on, okay, this is an idea I can build out over a few sessions, over a few weeks, and can take that position over the next month or a few, right? Um, Obviously, depending on the position, slamming a couple good ideas every month or every quarter that you really like I said. Um, like the Tesla one was a good one. That's a position I wouldn't. I mean, positioning yourself June 5th. That's it hasn't even been 20 days in this position. If you get a pretty good average, already had a good chunk, especially if you have TSLO. Um, Whereas the Nvidia short, right? This is one probably been in for like a month and probably plan to be in for 3 or 4 months. Building out a position on this is a month in itself. Same with SPY is a month in itself from man maybe half a month building that out and plan to hold it for 2 or 3 months. That's something I always like to discuss when discussing and taking into account a trade. Um, look at this price action. This is gonna fucking crash. Um, what's your time frame? What's your vehicle? You know, where's the risk and when's the risk? Obviously, the timing is pretty pivotal, especially if you're playing options where time is working against you. It can work with you, but it can also mainly work against you. And just really slamming a few ideas, right? Like slamming a few ideas is really how you make your money and how you make it with the least amount of stress. So that's it. That's it for me. Kind of not gonna trade for a while, but I think that I one last thing, I think I got a little stressed, right? Especially in this range. It's been a little stressful, and like I said, it's opened up my eyes a little bit in terms of where my best execution has been. And I mean, I've only been in this game for 2 years. I plan to be in this game for decades, and I think that the best opportunities are yet to come. I think that my best trades are yet to come. I think that the best execution I've had is yet to come, and I think that it fuck trying to turn, I like $2,500. Fuck trying to turn that into $100,000. Change my life off that. I mean, that's cool, but that's so mentally fatiguing and exhausting. And I felt a little bit like I was getting very burnt out every 5 minute candle, just consistently looking. First thing I do is check pre-market. Last thing I do is check overnight session on SPY. I would rather turn, instead of 2,500 to 1,000 in a couple of years, I'd rather try to turn 50,000 into 1,000,000 in 10 years, right? 15 years, something like that. A understanding that, right? I think I have a very, very phenomenal edge in these financial markets and how I can trade them. And I think that developing the capital, developing the patience, developing the security of maybe another source of income, and allowing my money in positions to work without having to worry about them and micromanage them is so much more appealing to me. It's so much more appealing to me to allow my positions to work themselves out, set the alerts. Obviously, look at the charts every night. Look at the charts. Check how my movement is in pre-market over the weekend. But allow myself to leave the house during the day. Allow myself to Um, not have to worry about every position at every single time, constantly checking my P&L. I think that's such a stressful and mentally fatiguing and exhausting thing and concept. And I think that the best way to trade is to not have that happen. So I'm definitely going to focus on building out a lot of capital. I don't really plan to trade until really trade until I have $25,000 to $50,000 to put aside and develop a portfolio. Just one portfolio with all my ideas, right? With all my trades, higher time frame options, leverage exposure, shares, inverse ETFs. That's it. On a month by month and quarter by quarter basis, executing the ideas, having the time frame about them, maybe taking those intraday opportunities if I'm feeling a little ballsy, but not needing those intraday opportunities because I feel like as well as that, it's I wasn't able to capitalize fully in April. Why wasn't I able to capitalize fully in April? Because first of all, I didn't have the portfolio. So second of all, I didn't have the experience. It's I wasn't able to milk the full move, right? You don't need to milk the full move. You only need a piece of the pie. But how can you get the most out of a move while also not trying to milk it all? And that's adding in your winners. That's rolling your profits. That's setting your trailing stops. And it's just capitalizing on commons, right? The commons are fucking beautiful. People don't realize that. People are so attached and attracted to, 100% return. I mean, I've had 100% returns in minutes. I've had 1,000% returns, 400% returns, and nothing would beat just a simple commons trade, trailing stop, set your alerts, milk the full move, add in your higher lows. It's so easy, especially in sequences like this and on a few specific names. Like I said, the Microsofts, the Nvidias, the Googles, the reversion trades are pivotal, and the potential is inevitable, or the potential is out of this world. And you can really capitalize on the full move in the sense that I always have had this directional read of the full move. I was never able to capitalize on the full move. Why is that? Because I wasn't trading the correct vehicles. So just a quick little rant on where the real money is made. The real money is not made in zero D. The real money is lost in shorter dated options, right? Whether it be um, eating away at you via spreads or time and vol or just being wrong and taking a loss quickly. The real money is made in positions that you build out over a higher time frame perspective, and you just kind of sit back and wait. Um, and you can tell when that position's wrong. So, yeah, that's pretty much it for me today.